Another very important tool to use with technical analysis is a very simple tool called trend lines. The idea is you find a prominent low or support point, a support level, and ideally be a significant support or a big support level. Okay, and the ideal situation is extrapolate it to a second point and a third point. That's ideal, and then extrapolate it out. The more times it touches, the more reliable the trend line is. The longer it takes, also the more reliable the trend line is. And as the word would imply, as long as the share price remains above that support trend line, above those lows, the trend is up. Okay, so that gives you a indication that the trend is up. But also, if the share price comes back and it breaks out and closes below that support trend line, we talk about triggering a change in trend. And that also helps you to either get out, take profits, or it can also be a stop loss level and things like that. So use your support and resistance trend lines as entry and exit points. So in a bull market, you connect the lows together, that's what we call support trend line. In a bear market, we connect the highs or resistance levels. As long as the share price stays below that resistance trend line, the trend is down. So if you want to get into the market, you want to be in a situation, you want a confirmation change in trend, you want to see the share price break out and close above that trend line for you to confirm that the trend is changing. Okay. And when it comes to a sideways market, it's very important that you put that support and resistance trend lines in. That helps you establish when the price will break out. Some people like to trade at range-bound trades. I like to look at it as I put myself in the starting blocks and I wait for the breakout. And usually the breakout will be very, very strong, and that's what I act on. That's a trading strategy, and I know we'll be talking about a trading strategy next week, Tuesday night. Okay. But trend lines, very basic tool to use, but very, very effective. So remember, trend lines are diagonal and support and resistance levels are horizontal. So usually we find that the levels are usually around a number, be it 10 Rand, whatever the case might be. So you'll find there's a lot of buyers and sellers at those levels. Okay, so ideally you want to put a stop loss either above or below it, depends if you're long or short. Okay. So those are one of the very simple tools to use. And in building on that, we talk about chart patterns. And these two groups of chart patterns you can use. And again, from a trading point of view, you're going to use chart patterns to help you anticipate where will the market be going. Okay. So the first group we were looking at is what we call reversal chart patterns. As the word would imply, the trend is reversing. So some of the most popular ones you'll find quite often, the double tops, double bottoms. I always think of double tops as McDonald's arches. And it looks like a big giant M. The minute it breaks below that support trend line, that's a trigger that the trend is reversing down. So that's where you'll go short or you'll sell. Okay. So double top, trend reversal down. Double bottom, trend reversal up. So the minute we break above that previous resistance level, that'll be your buy signal as we will go long, okay, or you'll buy. So I always think of the double tops as McDonald's, and I always think of the W as the wimpy, okay. You also obviously get triple tops, triple bottoms, which are more powerful. Obviously, you find a more powerful support and resistance level. But some of the most common or the most important ones to use from a technical trading point of view is what they call a head and shoulders formation. As what it implies, there's your left shoulder, there's your head, there's your right shoulder, and you connect the two support levels together. That's what they call the neckline. What's important, you only act on the breakout of that support trend line. And what's useful about the head and shoulders formation, you can start using what they call price projection. I measure from the high to that neckline, and that same distance I project from a breakout. And this will help you anticipate a target price, a take profit or target price. You've got about 80% probability of being right. I always think that's a good odds. So if I got a sell signal here at 10 Rand and I know it's going to 8 Rand, I've got a chance of making 2 Rand, 80% of probability of doing that, I'll go short. Okay. So that's at the top of the market, trend reversal down. Bottom of the market, what they call inverse head and shoulders, exactly the same principle, breakout above resistance, and that's where the market's going. You also get what they call rising wedges and falling wedges. These things, if you're not watching it, you see the two converging trend lines. If you're not watching it, the breakout's very sharp and very obviously very powerful. If you're not watching the market, you're either losing a lot of money very short, a very short period of time, or you miss an opportunity to go short. In a falling wedge formation, remember, it goes against the trend. So it breaks out very sharply. So you start seeing this happening, you're going to go short or go long on that breakout. And this doesn't happen too often. This is where emotions have gone crazy. Market sentiment, you got two widening trend lines, it's like a megaphone. Motion's gone excessively bullish, excessively bearish, excessively bullish, excessively bearish, excessively bullish, and very bearish. Okay, so you start seeing that pattern happening. Either you trade it or you stay out. By the way, of all these chart patterns, it's very important that you bring a volume. Volume acts as a confirmation tool. You want to see increased volumes on the breakouts. Okay, that's confirmation of the price action. Yeah. So that's just a reversal chart patterns, very important tool to use. I use it a lot for trading, but my favorite group is what they call continuation patterns. We saw just now in the sideways market, a rectangle can move both ways. So this can be a reversal pattern or a continuation pattern. So if it moves from the bottom, moves sideways and then breaks down, all it is a complex triple top. If it moves from the bottom, moves sideways and then breaks up, that's a continuation pattern. So a sideways market, remember, it's a consolidation. But the continuation patterns, as the word implies, and some of the most important patterns you'll pick up is what they call triangles. He has a flat top, flat bottom. You usually find that this is a great pattern when you start seeing new highs, new lows. This is new highs, 52-week highs. Usually this is a pattern happening. The market is hitting a resistance level, and then we break out above it. And usually this is blue sky potential because there's no sellers here. Okay, so you start seeing this pattern happening with new highs or 52-week highs. It's a great pattern to trade. Obviously, in the forwarding market, a very important support level. Eventually, the support level is overtaken as more sellers come to the market, and new lows carry on making new lows. So this is the ideal situation you want to go short. But this is a pattern I like to trade a lot. It's what I call a triangle. In this situation, a symmetrical triangle. It must touch at least 5 times before breaking out. You can see two converging trend lines, and ideally, you also can measure that as a target price. The shorter version of this is what they call flags and pennants. The same principle applies. We move into a sideways trend and then break up, but continue on our original path before we reach into the pattern. Okay. Again, with all these patterns, remember, volume is very important, confirmation to use. Okay.